the Fed is doing something now that they've never, ever done before. You've got housing at all-time highs or close to it. I mean, there's sectors obviously that are weak in real estate and commercial has crashed, but you've got the stock markets at all-time highs, yet they're going to cut rates. They've never ever done that.
Right.
And if it were the market moving rates, rates would generally be moving higher just as a risk premium or risk adjustment to the fact that there is absolutely risk now in US Treasuries. They were always considered, the risk-free benchmark. They're no longer risk-free.
With a bigger than usual cut, the U.S. Central Bank has lowered interest rates for the first time in more than 4 years. The Federal Reserve reduced the target for its key lending rate by 0.5 percentage points to 4.75% to 5.0%. Precious metals expert Bill Holter warns that U.S. interest payments are soaring, yet the Fed is considering rate cuts despite increased debt risk. He calls this unprecedented, with markets near all-time highs, and argues that U.S. Treasuries are no longer risk-free. The perception of U.S. government debt as the world's premier safe haven asset is changing. The CEOs of both U.S. and foreign financial institutions warn of the dangers they've seen develop in recent years as U.S. Treasuries have become riskier investments. According to Bill Holter, the weakening of the U.S. dollar is becoming increasingly evident, as shown by its decline against other currencies. He highlights that while gold is priced at around $2,600, it shows the dollar's shrinking ability to buy an ounce of gold over time. Over the past decade, gold has provided an average annual return of 8.4% in U.S. dollars, consistently outpacing inflation. This makes it an attractive option for long-term investors seeking to preserve purchasing power. In late 2023, gold began a strong push that continued into 2024, reaching all-time highs of just over $2,500 in September 2024. From a technical standpoint, Holter notes that markets are manipulated using derivatives, especially in gold and silver. He predicts silver's true price is far higher than just $31 an ounce, with around 300 paper ounces sold short for every real one. Now we present the clips of Bill Holter's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Well, it's a mirror of the dollar. The dollar's testing on the USDX, which measures against, it's a piece of crap versus a group of pieces of crap. I mean, they're all paper. So it's paper versus paper, but the dollar is weakening versus foreign currencies. And obviously, if you want to look at you could say the price of gold is $2,600. The better way to look at it is a dollar is 1/2600th of an ounce. And at the start of the century, it was 1/300th of an ounce. Basically, it's the dollar. It's a lack of confidence in the dollar, if you will. You've got even foreign central banks exiting dollars, and they're publicly buyers of gold. On your initial comment about rate cuts, I find it interesting that now we've already spent over $1 trillion in interest in this fiscal year. It's going to end up at 1.1, 1.2 trillion. Next year, the number is going to be higher. It's going to be 1.4 to 1.6 in that neighborhood. And that number is only going to go higher. If you look at that number versus tax receipts, it's eating up an ever-increasing large percentage of the tax revenues. So isn't it interesting that the Federal Reserve can come out and say, well, but we're lowering interest rates. When a credit gets more risky, the marketplace itself places higher interest rates on it, not lower rates, as a form of risk premium. So the Fed is doing something now that they've never, ever done before. You've got housing at all-time highs or close to it. I mean, there's sectors, obviously, that are weak in real estate and commercial has crashed, but you've got the stock markets at all-time highs, yet they're going to cut rates. They've never, ever done that before. And if it were the market moving rates, rates would generally be moving higher just as a risk premium or risk adjustment to the fact that there is absolutely risk now in US Treasuries. They were always considered, the risk-free benchmark. They're no longer risk-free. What I'm getting at is they can prop markets up by using derivatives. They can also retard markets by selling the derivatives. Like I said, with gold and silver, I mean, that's for years and years, they've dumped paper contracts to the point where now with silver, you're probably looking at somewhere in the neighborhood of 300 paper ounces are sold short for every 1 real ounce that exists. Is the proper price of silver $31 an ounce? Probably not. It's probably many, many multiples of that once those shorts are forced to cover. Or if they're not forced to cover and the exchange just ceases to exist, then there's your great reset. You will find asset prices will reprice based on cash and carry, pricing.
Regarding the role of gold, Bill Holter explains that it is viewed as a competitor to fiat currencies, leading Western central banks to undermine its credibility. The Western US dollar faces increasing threats from gold, as its historical role as a stable store of value gains renewed recognition. Most economists have forgotten the importance of gold in mitigating tail risks. To use the words of Ben Bernanke when he was asked about it during a 2011 congressional hearing, central banks hold gold merely as a tradition. However, this situation is changing rapidly as more and more countries are realizing the advantages of gold as a reserve asset. According to the CPI, since the Federal Reserve's inception in 1913, the dollar has lost at least 97% of its purchasing power. Most of this decline occurred after 1933, when gold coins no longer circulated in the US, and no meaningful deflation was able to take place. Furthermore, Holter highlights the choice of saving in a currency by backing it with 20% to 40% gold over one from an insolvent issuer, as per the BRICS plan. He predicts that waning trust in the dollar will cause hyperinflation in the United States. Let's get back to the interview.
First, Western central banks, you have to understand that gold is the anti-dollar. So the Western central banks don't want to give any credibility to gold because it is a competitor, the direct competitor versus paper fiat currencies. They want to show you that gold is bad, dollars, yen, euros, etc. are good. As far as gold and silver, where do they fit in? They are money themselves. They are the original money. They're God's money. They are what dollars originally were derivatives of, what pounds originally were derivatives of. Think about currencies. You've got the lira, the peso, the peseta, the pound, the dollar. What do all those terms have in common? They all are a weight system. They have something to do with weight. And that weight was of silver, or that weight was of gold. And those paper currencies were originally derivatives of gold and silver. But gold and silver are the original monies. And they were the original monies because there's no liability. There's no counterparty risk. They cannot be printed. They cannot be debased. Whereas the paper currencies created by man, they can be freely printed, freely diluted, and they have been, because you can't trust man. If you had a choice of saving in a currency issued by a insolvent issuer versus saving in a currency that's backed 20%, 40%, whatever, by gold, it's got, say, oil, other commodities, something real, put your money into.
Yeah,
And
it's a
would you
no-brainer.
bet on the insolvent issuer? Yeah, it's a no-brainer. So yeah, it will absolutely smoke the West. And it's also going to create a huge trade problem because, I mean, here in the United States, we don't make anything anymore. So if you've got foreigners saying, we don't trust the dollar, we don't want the dollar, we'll trade with you, but we want to trade something real for something real, what you've just done is created a huge supply deficit of goods. And what it's going to look like is a massive hyperinflation of anything and everything consumable by people in the U.S., by the West. So it's going to smoke the entire Western financial system. And I do want to just clear up because some people have said that I'm the one who came up with 40% backing. I think what they said was it'll be between 20 and 40% gold backing.
Gotcha.
Maybe it's going to only be 10 or 15%. I don't know. I have no idea. It seems more likely to be closer to 20 than 40. But if it's 20, if it's 40, the gold price may have to go up only fivefold or eightfold. But if it's 20%, now you're talking about gold's going to have to go up tenfold, 15, 20-fold. It has to be big enough to back trade. And at current prices, it's dwarfed by trade.
Every fiat currency loses value over time, and the US dollar is no different. History shows that during high inflation, gold performs best. Suddenly, there is a renewed interest in the yellow metal, which begins to outperform. For instance, the price of gold has been up 20% for the past year, and this is probably the beginning. We are seeing record-breaking demand for gold from central banks worldwide, which is putting pressure on the price to rise. In addition, there is a strong demand for investment in countries such as China and India. Is this enough to make gold a viable alternative to the dollar? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.